most normal scenarios, demand for volatility, because of the way the market is structured, is usually bearish, right? That's the normal. So demand for volatility products going up means that generally as a rule people are buying a lot of bearish hedge protection. So obviously that's buying some cheap puts, for example, buying some cheap puts, selling some calls to obviously be more bearish into the market. So when we understand that, normal volatility increases is bearish. Normally we get that negative correlation, so therefore we get that very obvious negative correlation to equities. Now obviously when we come into a big data release like CPI numbers, like this example, when we come into a big data release like CPI numbers, if they're expecting a big number, now we obviously know that there is a potential for a big number in this one, then obviously one would imagine that what most people are going to be doing is they're going to do volatility hedges. And if they're doing volatility hedges, what they're going to be doing is they're going to buy long volatility, aren't they? So they're going to buy long volatility. That's not bullish or bearish. Long volatility in that sense isn't bullish or bearish. If you're long a put and if you're long a call, you're not bullish or bearish, are you? You're simply long volatility. So you're expecting a very sizable market break. But obviously that long volatility is still going to be expensive for volatility products, right? So VIX will go up in price. But it doesn't necessarily mean that it's bearish. Do you understand? You see the difference? It doesn't necessarily mean it's bearish, because if I buy a long call, I'm long volatility. So if I put in a massive long call position and a massive long put position, I'm long volatility products for a volatility market break. Now, obviously, that means that I could be bullish or bearish. All I know is I reckon this is going to be a big number for equities, positive or negative. And therefore, I'm buying a lot of volatility. Now, how do we make sense of this? Well, of course, one of the ways we can do that is we can look at the price of volatility. For example, the volatility of volatility. So we could look at, for example, VVIX, if we thought we could do an analysis of that type of narrative as well. So we could do VVIX. We could look at a VIX volatility index. We could look at the price of the volatility of volatility, and we can see whether it was going up or going down, and we could start to make some measures. Now, what else could we do? Well, we could see whether there was a lot of puts coming into the markets. So we could look at the puts calls ratio as well, couldn't we? We could look at the puts calls. Now, why would that be important? Because obviously if there's an awful lot of calls and volatility prices go very high, or if there's an awful lot of puts and volatility puts go very, very high, there's obviously going to be something of interest showing up here. Well, let's take a look at both of those two metrics from yesterday's market. Now, what I've done today in the classroom from this morning was we calculated out what the volatility pricing was, and we've posted it in Smart Alpha so you can see it for the 2-day volatility and the 1-day volatility. It's on the charts there. So when we look at the price of volatility, this is the VVIX. So the volatility of volatility seems to be rocketing through the roof. Normally, this would be an incredibly bearish scenario. Normally, this would be very, very, very bearish, right? Normally, you'd be expecting this market to collapse. Because that's normal, isn't it? You'd expect that market to collapse because anytime we've seen this type of price action, you see it, for example, here, you saw that price action there. What happened to the S&P? The S&P collapsed. So you're starting to see and recognize that type of price action. It's normal for the market to collapse inside of those areas. But it might just be long volatility, not bearish volatility. It might just be long volatility. Now, one of the ways we can start identifying that is by watching the movement of things like the puts, even the puts calls ratio. If we watch the puts calls ratio, of course, we can start to recognize what people's positionings are becoming in terms of that puts calls ratio, right? We can start looking inside the puts calls and we can start saying, well, what is the positioning in terms of the puts and calls? So they could look at PCC, So for example, we could look at PCC, and if we look at the PCC, this is equities plus indices for the puts calls, right? So PCC is puts and calls from the equities plus the indices, and obviously that adds that extra component to the puts calls ratio. And we'll get that squared away properly there. And we can see how much volatility is coming into the various markets. Now we can see when they tie up, and they usually do tie up, of course, most of the time. We look at puts and calls, and we look at puts and calls plus indices. We can see in here that there is a, there's actually a fairly sizable number of calls coming in at yesterday's close, isn't there? You see that? So the puts calls ratio actually goes down rather than up, doesn't it? Rather than up, it goes down. Now, obviously, when it goes up, normally one of the things that we're looking at is that's usually an exit of a long puts position. That's normally what we label this as. So anytime we see a big sharp rise, we're normally bullish at lower prices. So when we see a sharp rise there, we're normally bullish, and that obviously rallied the equity price significantly. And when we see a sharp rise here, we're normally going to be long equity prices on those dips, and that's why we got potentially a sharp rise there, because a lot of people exiting positions in that respect. But obviously, an awful lot of people perhaps starting to get positioned into the calls markets, but are they selling calls? Well, the price of volatility seems to suggest that that might be one of the strategies. However, this can be interpreted in a slightly different way in this occasion, because we could obviously look at this and say, well, you know what? They're actually looking at a market that potentially is just going to be straddled. So that high volatility is a straddling mechanism that could go in either direction. And that's just something that we have to just acknowledge. It's something that we can think about. It's something that we can consider. It doesn't seem as if it's out of line. So whilst the volatility would have had you running for the sell button at the close of business yesterday, I don't see it. I don't agree with that analysis in the face of it. I don't agree with that analysis in the face of it. And that's why I think in the overnight session, we've still seen some upside equity positivity. So I think that's a simple way to look at it. I know it's lacking in a lot of detail in there, but you'd have to break it down into individual stocks and sectors and various other things. Are they getting heavy into stocks? Are they getting out of stocks? So you could start to move away from just volatility analysis, and you could start looking at some of the rotational analysis. And most of the rotational analysis we saw from yesterday was actually really bullish the market. If you look at, for example, our beta zero on the S&P from yesterday, and you look at what the beta zero suggested, here was the beta zero for yesterday's S&P in the afternoon session. I mean, there's no question about whether we should be buying or selling this. There's a very, very large opportunity to be long the NASDAQ and the S&P through that phase, and that's the exact outcome we got. And sure enough, again, in the overnight session, another opportunity to be long through that phase. And then into today's session, London session, again, still a lot of bullishness coming into that measured move target that we suggested in the tweets. We've got that measured move scenario just into that 910 area. But obviously numbers are out in just 10 minutes. So we'll soon find out, guys. We'll soon find out what the numbers are. We've got the SPY narrative in place. And we're ready to do business. We've obviously hit target price on that bond. We got up to a high price of 14 for a full $1,000 profit. So that was lovely. Nice way to finish off your day, right? Nice way to finish off your day. So let's see how it plays out, guys. Excited? 10 minutes to go, guys. 10 minutes for the big CPI numbers.